On Monday, September 22nd, the S&P 500 shattered a historic threshold. Its price to earnings, or PE ratio, climbed past 30 for the first time in over 20 years. Now, that figure isn't just a milestone, it's a warning and an unmistakable red flag. History shows that stocks this expensive almost never deliver strong long-term gains. Instead, they set the stage for years of disappointment and sometimes outright disaster. Now, when the PE ratio hits 30, this means that you're paying a steep price for very little in return. For every dollar invested, companies are only producing about 3.3 cents in earnings each year. Now, that's not much of a payoff, and add in expected inflation of around 2.39% over the next decade, and future stock returns may average about 5.7% a year. Now, on the surface, that might not seem bad, but here's the catch. Right now, 10-year Treasury bonds pay 4.15%. That leaves stocks offering just 1.55% more than risk-free government bonds. Now, historically, investors have demanded a much bigger reward to put their money into volatile stocks. Today, that margin of safety has almost disappeared. And if valuations come back down to more normal levels, say from 30 to 25, returns could shrink to only about 2% per year. In other words, when you buy at inflated prices, there's little room for upside and a lot of room for disappointment. The stock market has only reached these heights once before in modern history. It was during the dot-com bubble. Now, from late 1998 through 2002, the S&P 500 stayed above a PE of 30. The crash that followed erased trillions in value, and it took 7 long years for the market to recover. Now, by contrast, before the 1929 crash, the PE was 20. Before the 1987 meltdown, it was 21. The current multiple of 30.09 isn't merely high, it's extreme. Much of today's market rally rests on a single pillar, which is artificial intelligence. And Deutsche Bank analysts note that AI-related capital spending is so massive, it is effectively propping up the US economy. AI machines, in quite a literal sense, appear to be saving the US economy right now, said George Savarellos of Deutsche Bank. In the absence of tech-related spending, the US would be close to or in a recession this year. But there's a catch. Bain & Co. estimate that by 2030, global AI will face an $800 billion revenue shortfall that's needed to sustain demand for computing power. For now, companies like NVIDIA are carrying the weight of both the stock market and the US economic growth. And once the AI build-out slows, so too will its contribution to corporate earnings and GDP. Bad news is that in order for the tech cycle to continue contributing to GDP growth, capital investment needs to remain parabolic. This is highly unlikely, Savarello said. The imbalance is stark. This year, the S&P 500 is up 13.81%, but the equal-weighted version of that index has gained only 7.65%. So that gap shows just how much the so-called Magnificent Seven tech giants are skewing the entire market. Without them, the broader economy looks much weaker. Federal Reserve Chair Jerome Powell also recently acknowledged that the asset prices that he sees are fairly highly valued. For a Fed chair to make such a statement is no small matter. It confirms what many already fear. Today's market is priced as if nothing can go wrong. Stocks are trading at levels that assume steady growth, strong profits, and no major setbacks, leaving almost no room for error if the economy stumbles. So why are investors still piling in? Economists call this animal spirits. It's the term that John Maynard Keynes used to describe how optimism, fear, and herd behavior drive financial decisions. So in today's market, animal spirits are everywhere. We have meme stocks, speculative trading, and relentless enthusiasm for AI that are all fueling these valuations. But animal spirits cut both ways. When sentiment turns, markets can fall as quickly as they rose, and the warning signs are clear. Stocks are dangerously overvalued. They're heavily concentrated in a handful of tech names, and even the Fed admits that prices are far too high. And so if you're concerned about the current state of the economy, the stock market, the valuations that you're seeing, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolio can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.